This episode is brought to you by Suzy, a cutting-edge market research software platform that empowers some of the biggest companies in the world, like Citibank and Procter & Gamble. To find out more about how Suzy can help you stay competitive, go to tearsheet.co/Suzy. Welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. Joining me in this episode is Frank Chaparro, host of the Scoop Podcast and the Director of Special Products at The Block. He also writes a bi-weekly newsletter. We'd like to hear about that a little bit later. Chaparro started his career at Business Insider, where he specialized in the intersection of digital assets and Wall Street, market structure, and financial technology. Also went to Fordham University. Welcome to the podcast, Frank.
Thanks for having me. Good to be here.
Excited to talk about this with you because I think we spoke about it in our prep call. But one of the challenges we have looking at through the lens of traditional finance and looking at these new technologies out there is like, how real is it out there? What are the hurdles to get there? Is there really organic demand for that type of stuff? Or like, what will I be left behind if I don't adopt this stuff? Maybe we could start there. And I think in your career also sort of speaks to the evolution of the space. Where do you think we are in terms of like sort of the rollout of these types of technologies?
Yeah, it's a really good question, and I haven't done a podcast in a while, so hopefully I'm not too rusty.
You're a natural.
I'll dive right into it. Typically, I'm asking the questions, which is a much easier job, as you know,
Isn't it?
than answering
Isn't
them.
It? Yeah.
Especially with the help of ChatGPT these days, or I call it Frank GPT. Well, it's a really good question. I think the challenge on the part of major financial services companies as it pertains to any innovative technology, but especially crypto over the last 7 years as I've seen it, is it's hard to reach that sort of point at which sort of the innovation reaches like an escape velocity outside of the classic innovation labs. And that makes a lot of sense because you think about these institutions are managing, in some instances, trillions of dollars, or at least they custody trillions of dollars, or they're managing billions of dollars of assets. So to sort of, change the way in which they operate to offer innovative, weird, funky products is a challenge when, as our parents often told us growing up, if it ain't broke, don't fix it. And I think that's kind of like the model under which a lot of these firms operate. First, do no harm. And when you're thinking about, moving your pipes and plumbing and your infrastructure onto something like blockchain or decentralized finance, or even as something as simpler as offering just a ETF product tied to Bitcoin, this is in many cases a Herculean task. And so that's the problem. I don't think it's a matter of a lack of ability on the part of these banks. It's just at this point on the product side, when you think about like ETFs tied to this market, it's just such a small component of the overall pie. And
Sure.
Then on the infrastructure side, we're very lucky, at least in the West, to have pretty robust, and particularly in the United States, pretty robust capital markets, probably the most robust, liquid, and safeguarded from a regulatory perspective, capital markets in the world. So when we think about the value proposition that blockchain and crypto offers to payments and capital markets, it's kind of like, it's not necessarily an order of magnitude better in terms of efficiency and ease. So that's in and of itself sort of an impediment for them to make that move. It's similar for many different technologies when you think about like broadband and other things. The first adopters or the quickest adopters maybe of technology are often places where an existing infrastructure doesn't exist. And so
right.
I think that kind of hits at the biggest challenges. At the end of the day, to use a very specific example, it's very easy to trade liquid U.S. equities in America. So the proposition of like moving that all on chain, it's attractive, but it's not necessarily attractive enough for like we were saying in the prep call, to kind of break through the cyclical nature of hype. So when we think about tokenization, historically, right, after you see a crypto drawdown, a lot of these banks that put X amount of resources into the subject or into the technology, ultimately you see those teams kind of like disband, and then they become they become like sort of cast off to the corridors or to the alleyways of the institution.
The development cycle is still tied to pricing, crypto pricing. Yeah.
100%, and that's not just an institutional problem. It's also like a user problem as well. And so, I actually do think, and I could be very wrong, that this is going to be the first cycle where we see a sort of bifurcation in that respect, where I think because we're at a certain price point, firms will feel comfortable enough to continue operating outside the auspices of just like a clandestine innovation lab and continued development. And same thing with apps. I think you'll see a lot of crypto apps still do relatively well, relative, that is, to the price. Even if price goes down, I think users won't go down in the same respect like we've seen historically, where if you have a Solana-based app, for instance, that sees user increase 80% with Solana price increasing 80%. I don't necessarily think this cycle you'll see a similar 80% drawdown with a price drawdown, just because these things are a little bit better to use. And that's another important part as well. I think firms are becoming more comfortable engaging with the technology, so it's not as much of a headache sort of pushing through the drawdowns to continue to work in this segment.
The financial industry depends on data, but not all data is created equal. Choosing partners who can separate fleeting trends from groundbreaking innovations is more crucial than ever. If you want to unearth what forces are shaping the industry right now, download our guide at tearsheet.co/Susie. Is there a killer app though? Is it real world assets tokenization? Is that what's going to get banks to come on? Is it demand pull through that their customers eventually going to want this stuff? Like, what is it what's the tipping point, I guess? Yeah,
that's a good question. I think that the one product that we've seen find actual product market fit, and this segment has had a long sort of windy history over the past 7 years, is what we're calling real world assets today, which a lot of people don't necessarily think of stablecoins as being real world assets, but in a sense they are the biggest component of this story, because they're effectively tokenized representations of a dollar. Dollars on chain, they say, and that market's exploded to over I think $200 billion in total sort of market cap across the various stablecoin providers. And at a very there's two things. You can look at it from the basic user perspective. It's super easy to just send stablecoins relative to anything else, whether it be PayPal or Zelle or any of the other typical functions of payments that your audience might be familiar with. It's just so easy. It's so damn easy to send stablecoins, and they work, and they provide more flexibility in what you can do with your money. It opens the door to sort of tick by tick interest, tick by tick payments. But then even from an institutional perspective, the amount of money, and I think Bloomberg reported this just a few days ago around the Christmas holiday. Let me see if we can pull it up. The amount of money that firms like Tether are making on stablecoins is astronomical. I think last year they clocked $10 billion. I don't know if it was net profits, but it puts them up among, I think, one of the most profitable companies in the world from a headcount perspective, because I'm pretty sure they're only I mean, my best guess, I think they're like 60 people.
Wow.
So 60 people printing $10 billion is quite a
Beats
valuable.
McKinsey. Yeah.
Yeah, it's better than a kick in the ass, as my grandmother would say.
What's the business model with stablecoins? Like, so how are they making that money? And is that a space where you think a lot of like traditional financial institutions will find sort of a foothold?
Yeah, so I just found the article. We're looking at SocGen, Standard Charter are among the banks that Bloomberg reportedly says are starting to explore or expand their efforts in stablecoin for payments and payroll.
Yeah.
And how do you make the money on it? So you think about it, right? You have a boat. It's kind of there's a trade-off here for the user, right? It's seamless payments. But unlike if I'm sticking my money in a high yield savings account, I'm getting 4%. With stablecoins, the provider gets to keep all that yield. So you have a firm like Tether sitting on, I think at last check, $120 billion in cash that they allocate. And these firms are really major, like sort of like currency money managers at the end of the day. Mm-hmm. Like you can kind of think of these things as like money market accounts, but
there has to be some level of liquidity available, right?
Tons, and they have to be plugged into all these banks, and like they have these bank providers because they're sitting in short-term dated treasuries, commercial paper, and it's a whole basket of different instruments that they manage to be pegged 1-to-1 to the dollar, and on that they keep the yield of whatever the risk-free rate is. And when yields were, when the yields were much higher, around 5 or 6%, they were that's just free money, and it's a lot of money. I mean, it's $10 billion in a year money, and obviously, I think Goldman Sachs put out a note last night saying they think that the benchmark is going to go down to 3.75%, but on a low-cost business, where you're sitting on a ton of cash. It's. I mean, I hate to say it's easy money, but it's quite interesting. And I would argue, when you think about some of the efforts of like BlackRock with Biddle and some of these similar stablecoin like plays. I mean, sure, there's an innovation element and an interest in configuring the pipes and plumbings on which they operate, but it's really a play to kind of get a piece of this really valuable pie that Tether sort of pioneered, as well as Circle and USDC. So it's at the end of the day, I think that the money will draw them in, and then like it will then maybe undergird other elements of the bank. But it's going to start with to your point, the product market fit is, and that really is at this moment stablecoin. And again, like I said, from a user perspective, I would strongly recommend that most listeners at least try to use it, because it is pretty cool. And then once you have stable coins, it's much more easier to engage with decentralized finance, whether that's parking your assets, to borrow against or to lend, and it's kind of like...
Stablecoins are sort of the bridge between the two different systems, right?
Yeah, the bridge, and that's exactly right. Yeah. That's exactly right. So I think stablecoins are kind of like, that's the product that has, captured some lightning in a bottle.
Mm-hmm. One of the things I wanted to ask you, Frank, was about sort of the high-profile flameouts that we had with FTX and Celsius and stuff like that. Not so much about what caused those, but more about the impact it's had on the industry. Now, I don't know, having spoken to bankers for many years, these are my friends. As you started out your talk, you were saying also, like, there's a reticence to getting into new technologies, and there's a defensiveness. We've had these big blow-ups, and yet I don't really think... I'm actually surprised that I don't think that has clouded even in the traditional industry from taking steps to move in. Well, I am curious. What do you think what do you think the impact has been?
Yeah, that's a good question. There's been myriad of impacts. I mean, obviously, it's a black eye from a reputational perspective,
Sure.
but there was also a huge impact on just our capital markets. I say that in a sort of very like, I refer to crypto as capital markets as if they're their own thing, and to an extent they are, because they are so, the market structure is so different in many different ways. Even the way in which the largest traders in our space communicate with each other is on Telegram versus something like Bloomberg Chat.
Right.
So it just looks very different. But I'll start with the impact on capital markets first. You had a massive credit crunch. So whilst a lot of people think about crypto or Bitcoin specifically's drawdown from whatever it was at the last peak, right around the time when FTX blew up, to that drawdown, I forget what it drew down to, maybe 20,000, I forget. A lot of people think like this was an issue of a reputational issue or something inherent to crypto. At the end of the day, it was really a credit crunch. This was a mini credit crisis that swept all of crypto's major lenders and blew them out quite fantastically. And it wasn't that there was something, and I'm not trying to pontificate here, but it is really core to what happened. It wasn't that there was something inherently wrong with these assets per se. Yes, sure, there was some weird shit going on with like, at the time, exchange tokens and meme coins, and there were some long tail assets that like, there was a little Fugazi stuff going on. But at the end of the day, this is a problem of credit and credit worthiness. Very basic sort of like issue that can quickly bring certain capital market participants to their knees. And that's what happened, right? You had a myriad of lenders basically lending to the same people based on collateral that was either bad collateral or under collateralized. And this is something that a lot of people get wrong or forget about that credit crisis. Yes, there were a lot of under collateralized loans. So folks like 3AC borrowing from lenders like Genesis with, just like I have money and showing that to Genesis and then getting a loan for, billions of dollars. There was some of that. But what it really was it was collateral that was over collateralized, but quickly as prices draw down, things can become under collateralized. And that's what happened with Alameda's loans that they had against FTT. When you look at the books and you see I've got collateral of $1 billion here, or whatever it might be in FTT, that looks strong because they're borrowing only 500 million or whatever it may be. But then FTT draws down 80%, and then you quickly find yourself in a position where you have to call on the loan, and that just swept everything, and that is what killed Voyager and Celsius and BlockFi. She had a complete wipeout of a credit market that was not necessarily what they call wrong-sided collateral. They found themselves on the wrong side of that. They also didn't necessarily have the staff at a lot of these places to do the proper sort of credit risk analysis. And so once you had that sort of tailwind of credit liquidity pulled out from under the market, the floor dropped. Okay. And that also led to a sort of liquidity gap. Once those market participants were gone, you had liquidity pulled from the system, as it were, which made markets more inefficient, which made things more volatile, less robust. And that's really the undergirding story of everything that happened. So that put our capital markets in tatters, and we're only just beginning to sort of exit the second order effects of that, of credit crunch. Obviously, when you have an asset drawdown like that, it makes it unappealing for institutional investors. But when you think about the rise of Bitcoin over the last year, let's call it, it happened without sort of this amount of institutional leverage in the system. So you can argue it's a bit more natural, it's a bit more organic. It also happened in an environment of cutting rates. So you didn't have this sort of like frou-frou leverage money sloshing around, propping up coin prices, as well as the ZERP phenomenon that sort of served as a liquidity tailwind across all assets. So now we're at a point where, to me, and people might disagree, and I'm no expert, I just play one on TV, I reckon that there is much more organic sort of fuel undergirding the rise to 90K, because at this point, Zach, there are no big institutional lenders in this market. I mean, if you think about the credit market being 25 billion maybe at peak, with Genesis as the poster child, as it were, they no longer exist. And that's the real thing. A lot of people think, oh, FTX, they went away. I mean, Genesis was really like that. They didn't commit fraud. So fraud is a bit more sexy for headlines than just a sound business kind of exploding, relatively sound, to FTX at least. But them going resulted in sort of the destruction of credit in crypto, and that's just starting to grow back. So when I think about going into 2025, there's three things that the market needs, and that's credit banking specifically, and you see new lenders entering. You see a bigger appetite for lending capital out. And then on the banking side right now with this new administration, there's a promise that banks who for so long had to worry about the ire of regulatory, not oversight per se, but regulatory sort of hellfire, that's less of a concern. And I would say that historically banks have been told by either their overseeing regulatory bodies or their internal policy regulatory teams and legal counsel that they can't hold the asset itself. And we're thinking about banks like some of the largest banks that have all toyed with the idea of custody, like Citigroup and BNY Mellon. That has really been stuck within the innovation lab, just because they've been told they really can't in a meaningful way do anything. And that's on like the capital market side. Now there's a bit more freedom. They really can't rest on their hands and say, well, our overlords say that we can't do this stuff, because theoretically in this new administration there's not going to be the same sort of pressure. But on the whole, looking at it from end to end, that the not just on banking specifically as a service, but banks as entities and everything that they do, from credit to banking to trading, this will be the first time where they kind of have a bit more of a blessing, as it were, to engage in these services. So that means for the first time, crypto will have, we have prime brokers, we have lenders, we have custodians, but it's not the same when you have like a Goldman Sachs or a Morgan Stanley provide these types of services. And now they potentially can. That's for crypto assets specifically.
So, I mean, in a way, what you're saying is it's not the lack of regulation per se that's keeping some of the bigger banks out of it. It's sort of internal policy, compliance, capital markets not wanting exposure maybe to some of these assets. So we're not really waiting for a groundswell of new laws on the books for them to get involved, right? It's sort of more of just getting familiar and comfortable with the markets. Is that what you're saying?
I would say that it's basically it's in a sort of limbo. So a bank's not going to do anything that they think there's a potentiality for issues in the future. There's no like law that says, I might get in trouble here because actually there might be certain whether it's the OCC or other
whether they're considered securities.
I haven't read up on recent sort of rules on the books. But it might be the case that one of those entities have said that banks can't custody digital assets, and I reckon that would change. And you also do have some law working its way through Congress that would give some clarity around the market structure, so what certain participants in crypto can do, as well as clarity around what stablecoins are. So there's no rule, there's no regulation or law that suggests that Ethereum is a security per se, but the question of it almost being a question for certain people is enough that a bank like a BNY Mellon may not be comfortable like setting up wallet infrastructure for it and like custodying these assets on behalf of their clients. But it's going to be hard for them with a new administration to continue to position themselves like that, because the demand for these ETF products have been nothing short of phenomenal. I mean, we're talking about some of the best debuts of a new ETF product in the 25 some odd year history of exchange traded products. And so at every bank across the street, you have legions of financial advisors whose clients are super keen to get exposure, and they're like 5 steps behind in that respect. And so at the very least, will Morgan Stanley, Goldman Sachs, will they be prime brokers and custodians for these assets in 2025? Probably not, but certainly they're going to have to start to open up the wealth portal, the wealth management portal for these assets to these clients, and that's just beginning, and that's another huge unlock for 2025, which is once these wholesalers start to open the gate to this asset class to their wealth management client. And you have a lot of firms like Fidelity, and I think even BlackRock have suggested like we're looking at 1 to 2 to 3% of their assets going to crypto. None of these firms have started that process. That's a lot of money. And we've had Eric Balchunas on the show, and he's tweeted this. A lot of advisors think of crypto as like a sort of, you have the traditional portfolio. You can think of like an omelet, very basic, I don't know how you make your omelets, but it's pretty standard, egg, maybe some spinach.
Mushrooms, onions,
Mushrooms, onions, maybe some peppers. And it's pretty basic. And then crypto is like the hot sauce that you put on top of the omelet if you're keen to do so. And that's going to be big. And I think a lot of people saw, at least in crypto, I think folks who work within a bank who are listening will understand how long it takes for new products to then be able to be pushed onto their clients. I don't mean push in a pejorative sense, but like banks are in the business of selling product. Mm-hmm. It takes a long time, right? Like, 6 months would be super aggressive. And these products only rolled out a year ago. So once that starts happening, you're talking about a boat ton of more capital that can enter crypto vis-a-vis these ETFs. And the thing that's interesting is, a lot of people, like I was saying, in our space, they saw this debut and they're like, all right, it's going to keep going. It's going to keep going. It's like, there's going to be a pop because the people who can access it are going to access it right away. And then the sort of, the big guns, as it were, they're going to take time for things to go through investment committees and actually understanding it, right? Like, I hope I'm not unpacking this ad nauseum, but you've got like 10 different ETF products for Bitcoin. And so you have to go through each one. You've got to pick the 3 that you think you might present to your clients as a component of the portfolio. And then you have to think about, like, how does this even fit into a portfolio? And that's probably the first step, actually. Like, where does Bitcoin fit into the classic 60/40, into the omelet? Where do I put it in the omelet?
In the sauce column.
Yeah, and then which sauce do I pick? I mean, there's Frank's, there's Tabasco, there's so many. So that's the process. We're sort of like still like scrimmaging through the catalog of hot sauces and trying to understand, like, what's even in hot sauce? Where do they get where do they grow the peppers for this hot sauce? Who's liable if, like, there's a fork in the peppers and, like, does the client, do we put those peppers, that fork, on a different pepper chain into that hot sauce? And it's a lot of confusing, thorny work. Do I have to open a wallet?
I think this is a book subject coming up for you.
Yeah, right. I mean,
Frank sauce.
Yeah, I mean, I do like hot sauce, and I guess I'm a bit hungry this morning, but that's where we are. So it's a long-winded way of sort of presenting sort of where we are in the adoption cycles of ETFs, and that's sort of that's probably seen the most penetration. But you'd be surprised that outside of those wholesalers, I don't have the numbers, but just anecdotally, like speaking with people in my family who might work in financial services, there's still so many advisors who, like, are mandated not even to speak about crypto with their clients in the year 2025, which is quite phenomenal to me. But that's where we are. So on the ETF side, in terms of adoption, it's hard to think when you have billions of dollars under management for some of these funds. It's still super early in terms of these firms, like, wrapping their head around these products.
It's interesting because I didn't expect it, and this shows, I guess, I'm a neophyte to the space, but I didn't understand initially how important it was to get sort of the institutional investment, skin in the game on the capital markets side, because I'm more concerned about products and he's pushing marketing and product market fit and how that fits in to a bank's product portfolio, but. From what you're describing, it's sort of like the needed first step, it sounds like to me, before the rest of the stuff comes. I would have thought it came afterwards. But we're getting near the end of our time together. I have one question I want to ask you because I think it's really important for me and for our listeners as well. Like, you've been in the space from the early days. Like, how do you decipher what's real and what's not? How do you decipher sizzle from steak? How do you figure out, like, because there's a lot of hype here, and there's a lot of, like, every new market, there's always hucksters in there, and they always get shaken out at a certain point. But, like, there's a lot of money at stake here. How do we make sure that we do this right?
I get a lot of help from Jack Daniels. I reckon that when you think about a lot of what crypto is a call option on something happening in the future, and there are in the meantime, it's not even so much there's fraudsters and all new technologies, but it's more so hype. So how things are manifesting today might hint at a use case in the future, but the manifestation in the present is kind of like in an uncanny valley of, like, uselessness. And so NFTs is a great example, and the metaverse too in 2022.
I kind of liked NFTs.
They were cool, and they were
cool,
like,
for collectible space.
Collectibles, but like what they could do, how they manifested was in a sort of ridiculous, monkey images and all the other things, and all of that went to zero. And okay, yes, so deciphering, like, the good NFTs that will, like, appreciate in value over time from the bad ones that won't, that is something I'm not in the business of doing. If I was, I'd be taking this call from a yacht probably instead of a second bedroom office.
Not the Bored Ape yacht, though.
No.
Well, so it's more about the technology and then picking the things that ride on top of it, right?
Like, because what NFTs could
NFTs is good technology.
Yeah, what they could do is, like, different transfer of property and kind of, what they're doing in Argentina with, like, sort of digital identity and, like,
royalties
and allowing for, if you've ever purchased a property, the deed transferal process is quite a painstaking process. If you can sort of like tokenize that and have a deed manifested or represented in the form of an NFT, there's a lot of efficiencies there. So to use that as an example, picking winners and losers in the early innings of like what this technology can do is very difficult, if not impossible, and not for the faint of heart. But it does point to something that can happen long term. Meme coins is another thing. Like I think the idea of like financializing culture is quite a funny proposition. Like the person who invented any meme that like the angry cat from, what was that, like 15 years ago or something. The person who came up with that like had no financial upside to that becoming a viral sensation, whereas meme coins allow us to, in a way, extract more value out of humor, which is an interesting proposition. But similar to NFTs, thinking about the present in terms of, well, we can all agree that like extracting value out of culture in a new, unique way is novel and fun. But does that mean that like stink coin's going to go up more than like, doo-doo coin? That's a more difficult proposition. But how do I kind of approach each thing with a bit of skepticism, and do try to think, well, what can this do 3, 4, 5, 10 years into the future?
Frank, it's been great talking to you. I'd love to catch up with you in the future, when the future becomes the present, to hear about where we sit in the cycle, according to your perspective and your purview. Thanks for joining us on the Tearsheet Podcast today, Frank.
I appreciate it. Thanks for having me.